This video is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial professional. Links and resources are available in the description below. So, the big story coming out of this month's jobs report is really all about, well, balance. The US labor market, it's not exactly booming, but here's the thing, it's not falling apart either. We're seeing this slowdown in both hiring and layoffs, and that's creating a really tricky, complex picture for investors and, of course, for the Federal Reserve. All right, so let's get right into it. What did the core numbers from this latest report actually tell us? First up, the U.S. economy added 50,000 jobs in December. Now, a positive number is a positive number, but that actually came in below what analysts were expecting. They were looking for around 73,000. For you, the investor, this kind of signals an economy that's cooling down just like the Fed wants, but it's not, falling off a cliff. And that's a really delicate but super crucial distinction. But at the same time, look at this. The unemployment rate actually saw a pretty solid improvement. It dropped to 4.4% from 4.6% the month before. This is a huge metric the Fed keeps its eye on, and a drop like this, it suggests the labor market still has some real underlying strength, which, takes the immediate pressure off for any big, drastic policy moves. We also saw annual wage growth tick up to 3.8%. Now, bigger paychecks sound great, right? But here's the critical context. That growth is still trailing behind the estimated inflation rate of 6%. And what that means, in simple terms, is that real purchasing power is actually going down. That's a headwind for any company that relies on consumer spending and really for the whole economy. The headline numbers, they give us a quick snapshot, right? But the real story, the one that matters, is often buried in the underlying trends. So let's dig a little deeper here. And wow, this chart, it really puts everything into perspective. When you zoom out like this, you can see a super clear downward trend in job creation over the last couple of years. The labor market has been gradually, steadily weakening, and that right there is a huge reason why the Fed has been so laser-focused on its next move. Now, this is fascinating because it gets at how volatile the data itself can be. The initial numbers we get, they're almost never the final word. Take October, for example. The first report was revised to show a much bigger job loss. It went from 105,000 all the way to 173,000. November's numbers got revised downward too. It's just a good reminder that the first print is, well, it's just a first draft. So this brings us to the big so what question. What does this whole mixed bag of data actually mean for the Federal Reserve and its next big decision on interest rates? Okay, so heading into this report, the market was pricing in about a 13.8% chance that the Fed would cut interest rates at its upcoming meeting on January 28th. Not a huge chance, for sure, but definitely not zero. And then, after the report dropped, look what happened. Those odds just plummeted to only 5%. And the logic here is pretty simple. Since the jobs data wasn't a total disaster, the pressure on the Fed to jump in with a rate cut to prop up the economy, it's just faded away. The urgency simply isn't there anymore. By the way, if you find this overview helpful, please consider subscribing to the channel for more concise market updates. And this whole let's wait and see attitude, it goes way beyond just January. If you look ahead to the Fed's March meeting, the market is now pricing in an even higher probability. We're talking almost 69% that interest rates will stay exactly where they are. All right, so let's shift gears a bit. Let's talk outlook and see how all of this is building a picture for the year ahead. To understand where we're going, sometimes it really helps to see where we've been. In 2025, employers announced something like 1.2 million job cuts, and the sectors that got hit the hardest, it was government, technology, which is still grappling with AI and hiring too much before, and warehousing. All this data, it really boils down to one key question for investors, right? Out of all these different numbers flying around, what is the one thing the Federal Reserve is watching most closely? And honestly, they've been crystal clear about this. The Fed's number one focus right now is the unemployment rate. And what's really interesting is that their own internal forecast projects that the rate will end 2026 at, get this, 4.4%. That's exactly where it is right now. That tells you they're expecting a year of stability, not some major collapse or a big surge. So how did the stock market take all this news? Pretty calmly, actually. We saw a modest little rise, but nothing crazy, and part of that is because the S&P 500 was already flirting with record highs. For investors, this not too hot, not too cold report basically meant, okay, no reason to panic and sell, but also no new reason for a huge breakout rally. It just kind of reinforced the holding pattern we're already in. So here we are in this period of equilibrium. The labor market is balanced on a knife's edge, really. And that leads us to the final and most critical question for the coming months. What's it going to take? What will be the next catalyst that finally tips these scales and forces the Federal Reserve to make a major policy shift? If this update raised a question or insight for you, you're welcome to share it in the comments. Thanks for watching this video overview on 15-Minute Investor.